back to the perfect portfolio, guys. And, this is going to be a fun day. We are constantly innovating. We're constantly disrupting. And that was really the purpose of the perfect portfolio, was to not do things traditionally. And of course, buy, borrow, die is our favorite strategy. And that's what the billionaires use. And for some reason, it just never made it into our financial education curriculums in the entire world that I know of. So that's why we wanted to teach it. And of course, we're getting better, and we're optimizing it, and just getting better all the time. So no, I think that we're gonna record this today. We've never done this before, but I think we're gonna take this recording and put it on our YouTube channel, because I think it could add a lot of value to things and answer some questions and things like that. And I know we have a guest speaker on here today, so it's going to be a lot of fun. And so if somebody's watching this on our YouTube channel, hey, welcome to our channel. All right, we teach buy, borrow, die. We innovate, we disrupt. We'll teach you all the tax codes, essentially, so you don't have to pay a lot in taxes. I'm currently making a move where I'll pay very little taxes for the next 2 years. Okay, and they're all using the tax codes that we use in the perfect portfolio, and they have to do with real estate. And that sort of thing. But if you know the right tax codes, you can pay very little or nothing in taxes for many, many years. And there's always a way to reduce taxes. We have people in this course who are very new. They don't know anything, and they come in. One of our clients is very wealthy, and we're doing some pretty sophisticated tax planning with one of our partners. He's a Harvard educated tax attorney, and he's going to save one of our clients about $700,000 in taxes. So we can help the person who doesn't know anything kind of learn and raise their financial IQ. We can take people who are 25-year veterans in the financial industry, and we can teach them some cool stuff. And it's been an amazing journey over the past 2.5 years, when it was me and Danilo and Nerelvi and AJ going, well, what are we doing? Right. It is like, we got to start this thing, build this thing called the perfect portfolio. But it's been awesome. And we're going to jump into it. So I'm going to jump into my slides, and then we'll introduce our guest speaker here in a bit. So, all right, let's look at, all right. So, okay, good. So, funny, our slides still say coming soon, right? When we were creating this thing, we didn't have nothing. I mean, there was nothing trademarked then. All of our trademarks are in place, that sort of thing. We own the phrase "automate your income" in the United States. So, nobody else can automate your income other than us right now in the United States, which is pretty crazy. So again, the purpose of this course was to raise your financial IQ, okay, and teach you things that you're not traditionally taught in the financial service industry, right? Anybody can go on a YouTube channel and learn to save money, get good credit, max out their 401k to save on taxes, and go get a Roth IRA. But that's not going to make you wealthy, right? It just isn't, right? I can run the numbers on it and show you that's never going to work. So what people call financial education, I don't call it financial education. I call it banking education, okay? And this is not something new for me. Remember, I wrote a book about the banking industry in 2009. So, and I put difference between banking education and financial education. Most of the education people get, it's bank funded, it's spoon fed to you, and it's there to make, feed Wall Street, okay? So you want to raise your financial IQ so you can spot better opportunities. You can make more money. You can learn to avoid taxes just like the rich people do. We want to teach you to fish, and then ultimately automate your income so you don't need to work anymore. There's an acronym called FIRE. It says Financial Independence, Retire Early. Okay, and that's the purpose. But when somebody thinks retirement, they think, oh, I'll be 60 years old and I'm not going to do anything, and I'll sit on a beach somewhere and whatever. That has nothing to do with that. Retirement means you're financially independent. You have more passive income than your expenses. So you get to do whatever you want every single day. Okay. That's retirement. Technically, I'm kind of retired, but would I stop working? No, this is way too much fun. Right. So, but it's fun teaching this stuff. All right. Now, So automate your, now we're not financial advisors. Okay. I used to be a financial advisor. We're not financial advisors because I couldn't teach this course if I was a financial advisor. I couldn't run a YouTube channel if I was a financial advisor. I couldn't write more financial books if I was a financial advisor. So it's a weird world when you can be really smart financially, but can't call yourself a financial advisor, right? So that's totally fine. Okay. So we just partner with financial advisors and fiduciaries and things like that. But again, we've covered in one of the courses that says if you get a financial advisor and then they call themselves a fiduciary, but they're working for a mega bank that has a fiduciary responsibility to the shareholders, that's impossible to be a fiduciary. Okay. So a fiduciary is supposed to have no conflicts of interest, there to trust. But again, if they're working for a mega bank, they are 100% there to maximize profitability for the shareholders. So when somebody calls themselves a financial advisor, I'm like, I don't know about that, right? So you want to make sure to work with a financial advisor or fiduciary that's not working for a publicly traded company, right? So they actually have, so we even talk about this in the orientation class of the course. So anyways. Okay, so we're not financial advisors. I was an options trader and real estate investor before I was a financial advisor. So I was making money trading stock options and stuff like that. And I came to the United States knowing nothing. And I just started raising my financial IQ, right? And I had the goal of becoming a sophisticated investor. I wanted to learn options and stocks and bonds and all the real estate and tax codes and stuff like that. And that was my goal when I came to the United States, become a sophisticated investor. So it's cool. It's kind of paid off. I was an investment advisor representative for 13 years. If you Google me, you'll come up with my SEC record or whatever when I was an investment advisor, what firms I was with. But then I resigned in 2018 because I was like, man, I want to teach these other things that you can't really teach as a financial advisor. And more importantly, I wanted to keep writing books. Okay. So quickly, I'm going to cover very, very quickly my current portfolio in M1 and then a couple little updates, and then we'll jump over to this. Okay. Again, the idea is raise your financial IQ. So you kind of know what you're investing and you know what you're doing in your portfolio. Okay. So let me see. Let's go to invest. Let's bring up this portfolio and let's see. Okay. So let's see. My portfolio is rocking. This portfolio generates about $1,000 a month. That's about, $10,000 a year. So it's about $900 a month is what the income off this portfolio is. It's got some tax efficient, SQY is tax efficient. Okay. So it's 60% of that portfolio. The dividends is long-term capital gains. So it helps to understand how things are taxed. My GOF is very tax efficient, a lot of return of capital in there. So those dividends, return of capital means no taxes, right? So when you're building a portfolio, you should understand what you're building it with, and then it kind of merges it together in an M1 pie, right? And then I've got my cornerstone. Again, cornerstone is like the S&P 500, but it goes up faster than the S&P and down faster than the S&P. I don't care. If the market crashes, I'll just keep buying more, right? Remember, I'm going to buy and buy and buy more and buy more and keep investing for the rest of my life. I'm never going to sell anything. If I need cash, I can just press the borrow button, right? So just accumulation, build income for the rest of your life, never, ever stop. And if you need cash in the future, build a big enough portfolio where you get, maybe $100,000 or $200,000 in dividends. Maybe you only need $100,000 a year to live, and you have $200,000 in dividends. Boom, just keep those suckers reinvesting and just take loans of $25,000 a quarter. And that's kind of the idea. And then you're going to build wealth. It constantly grows your income. And then you need to learn the real estate side, which we'll cover later. And that's how to wipe out taxes on the dividends and even your W-2 income from your job. We'll cover that later in the course. Okay. But CLM, the top three are very tax efficient. The one in the middle is the S&P 500 times 3. It's the S&P 500. It's just times 3. It goes up super fast and down fast. I don't really care if the market crashes next week, that thing will crash. I'll just keep buying more. And then the dividends will keep buying more. I hope it crashes. I'll make more money if it does, right? So I don't really care. But I have a plan. It's only 15% of my portfolio. But if we have a year where the S&P makes 30%, that portion is going to make about 100% rate of return. And then I could sell half of it and redistribute it or things like that. So I have a portfolio that's automating my income. It's automate the investing, automate the income, and I don't have to do anything to do it. Okay. Then I've got my TSLY, which is an NVDY, which is your synthetic covered calls. We're going to talk a little bit about that today, what that is, but those are some pretty high income investments and stuff like that. They do move with the TSLY up and down and things. And then there's this new thing that was created, which is Defiance QQQY. They put the money in bonds and government securities, and then they basically sell a put every single day. That didn't exist before. That's never been done in the form of an ETF. So I got a very but I know what I'm looking at, and that's the kind of what you want to do. You want to know what you're looking at and know what you're building there. Okay. So again, you got to decide for yourself how much to invest and what percentages. You have to do that because we can't really help you with that, but you can certainly start off slow, take baby steps as you're learning. Sound good? Cool. Okay. Now, the funny thing is, I was thinking about it today. I was like, man, if I could have done the stuff we were doing right now, like I might have stayed an investment advisor. Like I didn't feel like I was providing value, just selling a portfolio of diversified portfolio of stocks and bonds, mutual funds to my clients. And I didn't feel like I was providing value, right? So, but I think that the stuff that we do today, I think it's huge value. And then we have we'll have our speaker come on here. So, okay, cover ex-dividend dates. You want to make sure you know what an ex-dividend date is. You want to make sure you don't buy these things on the wrong time. Okay, so always know what that is and make sure you buy these things, because if you buy this in the wrong time, you might miss the dividend and get on that thing. So don't be running out there going, man, I'm going to buy those things that Mark showed on the screen or something like that. So let's see. Didn't know. Where do we go? Do we go to Yieldmax on that or maybe Mike or whatever? Where's the best?
Yeah, just go to Yieldmax, know, because they're on there.
Okay. Where's the ex-dividend dates? Down at the bottom somewhere.
If you can hear me, you should just click on the TSLY.
Okay.
If you scroll, click on any of the positions. You should.
TSLY is December 10th. I looked at that one today.
Let's see if it's there. Scroll down a little bit. There we go. This is a good explanation.
Okay, good. So basically, we have the 8th was today, right? Yes. What was it? Wait, what's the date today?
Today's the 6th.
Today's the 6th. Okay, cool. So basically, a person can still buy these things and still get the distribution. Is that right? 11/8.
So the declaration date. So we're going to talk about that a little bit, because there's been a lot of questions around declaration, X dates, and record dates. And what you really want to do is, if you're going to buy it as a new position, is buy on the declaration date, because you're going to need to technically own the shares on the X date and the record date. So it's by settlement, right? So it can get very confusing.
Yeah, for sure. And that's the thing like that. Don't make the mistake I bought. The first time I bought TSLY, I bought it on the ex-dividend date, and then I missed the dividend date. I'm like, oh, that sucks.
Right.
So, and that was a mistake I just totally made. I was like, I glanced at it and then I just bought it on the wrong date. I should have bought it the day before. Anyways, so just make sure you don't run out to these things and buy these things on the day. But again, you should be good. I just scooped up a bunch of CONY and some of these other positions yesterday, so I can scoop up some of those big dividends. So anyways, we won't go into details on that, but just make sure I wanted to cover the thing of ex-dividend dates to make sure that you guys don't do that. So anyways, there's Yieldmax ETFs. That's where you can learn more about this stuff. We're going to talk a little bit about Defiance ETFs and where that came from. But again, so you're sort of the order of this course is pretty simple. It's learn, buy, borrow, die. What is buy, borrow, die? It says brokerage account, you can invest it, never sell it, keep funding it, keep accumulating it. Eventually you can borrow at a low interest rate. Okay. And then you can do life insurance, you can do real estate, and your real estate, you can put a small amount of money down, control a large amount of real estate. You can rent it and generate tax-free income streams. And there's tax-free income streams going into buy, borrow, die strategy. Very efficient as far as tax structure. So learn, buy, borrow, die. And again, I say this on the YouTube channel all the time. It's the question is, can I take a loan secured by my investment? So can I leave the investment there and take a loan secured by it and not touch the investment? That's the test that I want to make sure I do with all my investments. Okay. So Now there's the do it yourself as you learn. You come in, you use do it yourself. M1's a great place to do it because you can build a pie, you can kind of automate it, automate the savings, let the dividends kind of buy the one that's go down. And then you can use M1 for simplicity. Interactive Brokers is another platform we have used in the past. Very complicated. But if somebody is experienced trader and investor and they're already on that platform and you said, Mark, I want to learn some new tricks on that side, just jump into my schedule and I'll show you some new tricks you can do with something called portfolio margin and that sort of thing. But and then there's the Schwab to do it for you. And that's recently been, what we're going to talk about today is they do it for you when you can have somebody options professionals do it for you. So without further ado, we got the man, the myth, the legend, right? Mike Puck here. And this is the do it for you. Honestly, we came into this program, we're like, we don't feel comfortable referring to any financial advisors because most financial advisors don't know anything about options. They can't trade them. They can't do creative and innovative and disruptive things. They're not disrupting and they're not innovating. And then boom, I ended up watching an interview and then reaching out to a guy named Jay Pestrichelli. And I was like, wow, the guy I interviewed the guy, took time to have me interview, and that one went well. And then ended up interviewing the CEO of Defiance and that sort of thing. And then we've just had a great relationship here because we believe in what they do and they understand buy, borrow, die. And we actually feel comfortable, bringing somebody on there. And I don't think there's any other financial advisors that I'd feel comfortable, having on this channel because they wouldn't understand what we're doing. Right. So anyways, so Zega Financial is the company. You guys can go to their website here. We'll take a quick peek at Zega. There's the guy, Jay Pestrichelli. He's the CEO and co-founder. This is the guy I interviewed. And it was a lot of fun interviewing him and talking about options because I remember I was an options trader before, like 24 years ago. And we had a great interview. And then it's just become into, we just really like what they do. And, there's this option. Danilo just read this book called Buy and Hedge. It's about an options trading book and stuff like that. And Danilo, pretty awesome book, right, Danilo?
Yeah, I enjoyed it quite a bit, because not only did it interest me, but I mean, what he's educating, the strategies that they're doing now, they're doing it, right? He's basically kind of teaching you what you're doing. So as I look at these new funds come up, I'm excited about it because I kind of understand what they're doing,
Exactly,
especially because I knew what options were, but I never traded or I never really, looked into them or tried to play with it. But now I'm actually doing some just for myself, just to understand it more intimately, so I appreciated, reading that. So anyhow.
Yeah, sorry. Some of our students have started reading that book and just raising their financial IQ, and that sort of thing. So very cool best stuff. And then we got, there we go. And then there's Mr. Puck right there. So, and let's see what else. Here we go. So we'll have Mike cover this, but US Today said they're one of the best financial advisory firms in 2023. That's a pretty good statistic number there. They're fully SEC registered fiduciary advisors, except again, they're highly specialized. I know they manage money for large, institutions, really large amounts of money, and that sort of thing. Now, if you're like, man, this is cool. I like the perfect portfolio. This is something that I want to learn more about. And then you can also just, if you're like, hey, I love to talk to Mike or whatever, get that introduction. You can text us at our 800 number, 833-455-4540. If you just text the word Zega to that number, we'll know what you're texting about. And then we'll just chat with you and see if, and we can make that introduction to Mike if you think this is something that you think could benefit you. So just that's the best way to reach out to us is just text us at that number. So anyways, Mike, man, we're happy to have you here. It's fun to talk to options people who speak my language and hedging. I mean, what's what we talk about in this course always the time. The purpose of this course was to say, look, if interest rates go up, interest rates go down, how are we going to do? If the market crashes, are we going to be okay? If it goes up, are we going to be okay? If whatever, we wanted to hedge everything. If you get sick, we're going to be okay. If you get long-term, if you get sick, you need care, it's going to be good. Hedge everything, right? Hedge everything. when it comes to investing. And that's what these do. Remember, the book's called Buy and Hedge, right? And that's like one of the rules is hedge everything so you can never get wiped out. And that was one of the goals of this course. So, all right, well, cool. Well, Mike, I'm going to hand it over to you, man. We're happy to hear from you. And you know, if you guys ever end up in Miami and you want to, like, you know, go grab some coffee, right? I'm sure Mike might be up for that. So, all right, man, we're passing it over to you.
Yep. All right. Thanks, Mark. I appreciate it. And, you know, Danilo, like I said, you're in Miami this weekend at your own risk with everything going on. Enjoy your weekend. It's going to be a big one. All right. With that, let me share my screen here. And let me just show you guys a couple things. And I'm going to bounce around a few presentations. So I'll give you a little background on the firm, who we are, what we do. Mark hit a lot of the high points. And Jay is the co-founder of Zega Financial. We've been around since 2011. As of July 31st of 2023, we manage over $1 billion. We just were here in Miami this past weekend and had an internal group meeting. And that number, when we update this as of December 31st, we will most likely, you know, knock on wood, be above $2 billion in assets at this point. So we are growing at a very fast rate because of some very unique and interesting strategies we've been introducing to the market. I think it's something that not a lot of people are doing, and now there's some kind of people catching on. So there's some people learning about it, and there's more people learning about options, and that's exciting because we want to share our knowledge with the world. We think that options are a better way to invest, and we think we can provide protection, or we can provide income, or we can provide more growth when we implement option strategies. We'll talk a lot about some hedging too, and some of the hedging in the book. And there's times when you want to hedge, and there's other times where you don't want to hedge, or maybe it's a little too late to hedge. So I'll talk a little bit about that. We are what we call GIPS compliant. So we claim to be a GIPS compliant firm. What that means is we are audited by a third party. So if you ever look at performance numbers on our website, zegafinancial.com, and you see something and you wonder, you know, those are pretty good numbers. I wonder if they're audited. They are. Everything that's on our website currently is audited by a third party. Like Mark said, Buy and Hedge, the 5 iron rules for investing over the long term, was written in 2010, 2011, and it talks about hedging the portfolios. We are known in the media specifically for options, whether it's Derek Moore, who runs our podcast, or it's Jay, who's been on CNBC or Fox Business, or you've heard me somewhere on a YouTube channel or on the podcast or anywhere. We are in the media quite a bit. So Bloomberg, Yahoo Finance, Jay actually has contributed to the Wall Street Journal as well. So we're in the media, and you may have seen our name somewhere, or maybe you'll recognize it next time you see it. Quick screenshot of the team. We're about 10 people now. We are growing very quick. That is a picture of us in New York ringing the stock exchange bell. Or the New York Stock Exchange bell, and that was really fun. And we've got to do that a number of times, and we may get to do it again here shortly in the future. So really exciting stuff. Just a quick note on myself, as I've been in the industry now coming up, I guess it'll be about 18 years here. And I got my start actually in New York City. And if there's any watchers of CNBC in here, if you ever watch CNBC or Fox Business and they cut down to the floor, the trading exchanges, I was actually on the floor of the exchanges, and I had a purple jacket, and I was screaming and yelling and pushing and fighting, and we were trading options contracts, and that's how they used to be traded for a very long time. And, you know, now obviously we do all of our trading from a computer, but at one point, you know, obviously stocks were traded down there, options were obviously traded there, commodities. Everything was really traded on exchanges. And so that's where I got my start. And a great year too. And I'm kidding by that because it was 2008. So an absolutely horrible year to get started, 2007, 2008 in the financial markets. But either way, you know, I was very fortunate to meet Jay and the team. I believe it was about 2016, really, when I started to connect with Jay, and I worked indirectly or directly now with Zega for coming up on 10 years at this point. I was a financial advisor that used Jay and his options expertise with the team for my clients. And 3 years ago, Jay said, hey, why don't you come on board full time and start working with our clients? So that's what I've done. And it's been a great experience, and we continue to grow. And I think we really are leading the charge when it comes to financial innovation. And we'll talk about some of that tonight. So you probably have heard a lot about Yieldmax and the Defiance positions, or maybe you've seen those if you know, kind of just followed buy, borrow, die at all. And those are definitely strategies that we use. And in the Yieldmax positions, we actually used covered calls. So what I wanted to do is just show you guys what an example of a covered call looks like and what that does. And we use something called synthetic covered calls. And I'll get into that in a second, but this is just a basic covered call sheet of a dividend stock. If we were to own a stock and we were to try to write a covered call over the top of it, right? Calls and options in general, right? Those are the right, not the obligation to create a certain action, right? So when you're buying an option, you're buying the right to do something. You don't necessarily have to do it, but you're buying the right to do it, right? And in an example, I could say, I'm buying the right to buy Apple stock at 150 bucks, right? I'm buying the right to do that. There's a cost to do that, but I don't have to do it, right? So if Apple goes down to 100 bucks, well, I don't have to buy the Apple stock at 150 bucks because it's only trading for 100. So again, options are always the obligate or the right, not the obligation to do anything, whether I'm buying or selling. All right. So here, what we're looking at is just a chart of a stock, and this could be any dividend stock. And what you can see here is here's the dividend. So right, as long as we own the stock on this date, we're going to capture that dividend. So what we do up here is we will actually sell a call, and that will generate us income as well. So you can see for this specific position in this example is we own the stock, we collect the dividend because when it goes ex-dividend, we collect the income. Then and also we're selling a call over that time frame. We might get and again, this is a little bit more conservative, but in this example, our goal is to capture 4 dividends at all 1% each, right? Here's a capture, here's a capture, here's a capture, and here's the 4th. And we are selling a call over each one of these. So these are once a quarter where we're also getting about 1% from selling the call. The goal of this portfolio is only to do about 8% of income per year. But this is the idea of what you're doing is you're selling above the current stock price, an options contract. It's generating you income, right? Because when you sell something, you receive income for selling it. Just like if you were to, right? If I were to sell a water bottle, I would get cash for the water bottle, right? You're selling something and receiving income versus if we're buying something, right? Then we're giving out money or we're giving out dollars to do that. But this is just a great example of what a covered call looks like, right? You can do this on most stocks as well. A lot of the big tech names are good to do this on, but you could do this on a company like AT&T or Verizon. Obviously, the big ones like Apple and Google and Facebook, those are all doable with options. And the options market is a very, very large market, is a multi-billion-dollar market. So if you're getting into options, you don't need to think, well, this isn't as big as Apple or as big as Google, so I might not have liquidity. Well, that's just not true. The options markets are enormous and again, trade trillions of dollars every year. So most companies have a very liquid options market. Not all of them, but most of them do. Obviously, the big names do. So this is just a neat way to look at a covered call. If you were to own a dividend stock that was giving you 4 or 5% of dividends, you could double the dividend by selling quarterly calls, just like we're doing here, on top of that dividend, on top of that dividend stock. So again, just a way to enhance the dividend that you're getting. And if you think about a company like Apple, which we can talk about in a second with Yieldmax, is Apple only pays 0.5% dividend. So great stock to own, right? It's got a lot of growth potential, but it doesn't pay a lot in dividends. But what if we could really increase that Apple position, that dividend that you receive, and take it from 0.5% to maybe 30% or 40%, or maybe even 50% in a real volatile year, or maybe even just 5%. You want to just increase some of the Apple to make a little bit more. There's all these different choices when you look at the options market. So this is a great way to think about selling covered calls. This is done on a quarterly basis in this example, where we collect our dividends and then we sell our covered calls. So again, I think this is a great way to start with calls.
Yeah, and that's a thing like that. I remember being a going to, man, I spent, must have been a year, I had to go to courses and computers to try and learn about trading options. These days, it's cool. You can buy an ETF and somebody has super complex options trading doing in your ETF. You don't have to do it. So that's the point of automating your income is it helps to understand this stuff, because your goal should be to, eventually understand this stuff, right? Because I started at nothing. I had to learn everything from scratch, and it just took me a while, but I persisted, and that's it. You're not going to understand everything today, but you don't need to. You just understand a little bit more every single day. Make sense? So cool thing is you don't have to do it today. You can just buy ETFs. Every one of my positions in my portfolio has something to do with options in it, or there, so then we just combine it in a pie kind of thing. So anyways, back to you, Mike.
Yeah, that's a good point, Mark. And so, yeah, this can be very complicated, right? If you were to own Apple and Tesla and Amazon and Google and try to do this on every single one, obviously this would be very tedious, right? This would take a lot of time to look at all those different positions, figure out where to sell the calls, when to roll them, how to protect the downside, all that stuff. That can get really, really complicated. So we've done that. We've kind of packaged a strategy that does that. But let's talk about hedging first before we get into some of those positions. So I'm going to pop another screen over here, which this shows what a downside hedge looks like. And this is a completely different strategy. And we run a lot of different strategies. So, if we end up speaking at another time, right, we can kind of dive through and dig into the strategies. But this is one that we call buy and hedge. And this was actually what the book was based off of. And this right here, what we're looking at, let me get my pen here. This is kind of neat, right? So the blue line the red line here. Let's start with the red line. This is our stock price, right? And this is the S&P 500 in this example, right? So it goes, if it goes to the right, that means the market's going up, which means the stock goes up. If it goes to the left, right, you can see we're going down. So the stock price is going down. Well, what if we could tell you that for a little bit of cost, what we're going to do is we're going to get you a big portion of the S&P 500. We're going to build in a downside protection piece here, so that if the market goes down below a certain area, well, you're going to be protected. So we can actually build in put options to provide downside protection in the portfolio. So this is just an example of one of the strategies that we do. But what we're doing here is, again, if the market drops, well, we'll put a floor in and say, okay, great, we're not going to lose more than 10% or 12% or 2%. We can make these, again, options give us choices, so we can get as tight or as wide as we want protection-wise. So this is a great strategy, and kind of what we're doing and what we've been doing for a lot of clients is a combination of all this stuff. So we put together income strategies with downside protection. And again, it's a neat way where I think we haven't, maybe a lot of people haven't thought about investing this way before. So, but let me look at one more thing. Why would you want to provide downside protection, right? Why would that be important? And this is a great chart that just shows rebounds. Why hedge, right? And this is the S&P annual losses, over the past 22 years. And I think what's so neat about this chart specifically is, look what happens if we have a 10% loss in the market, right? This red here is going down. Well, we need to make 11% to get back to even, right? So if you have 100, and let's use $100 bill as an example. If you have $100 and you lose 10%, well, $10, pretty easy. Now you got $90. Well, if I make 10% of $90 the next year, that's only $9. So instead of getting back to 100, I only get to 99, right? So I actually need to make more than what I lose to get back to even. And this is a great example of that as we start to show. If you lose 10%, you need to make 11% to get back to even. But what if you lose more money, right? What if you lose 20%, right? So again, $100, we go down to $80, that's $20, 20%, that's easy. Well, 20% of $80.
Screenshotting before with my finger.
What's that? Oh, sorry, I heard somebody. But absolutely, right? So again, if you make 20% of $80, that's only $16. So now we're only back to 96. So you actually have to make 25% to the upside to actually make enough to get back to even. So again, this may be stuff that you know or you've thought about, or you looked at your portfolios and seen, but the more you lose 30%, you need 43, 40%, you need 67. And if you lose 50%, you need to make 100% on the upside, right? So again, this is why hedging starts to become very important for certain portfolios. All right, now let's talk about when hedging and why, because this can be really interesting. And so this is a chart of some of the hedges that we've actually put on over the past few years on just the S&P 500. And what you can see is what hedging does is avoid losses. Here on this chart specifically, as the market kind of went down, let me get a good color here. All right, so as the market went down, well, we actually had hedges kick in. So when we had our hedges kick in right here, and this was actually during COVID, market lost 36% in 3.5 weeks. It's one of the most significant black swan events we've ever experienced in history. But if you had a hedge on your portfolio, well, you only lost 10%. So guess what? While everyone's trying to make back up money after those losses, we're already up. We're back to even and off to the races. So the hedges can work significantly when there's big downward moves in the market. You can see here to the right too, there's a couple other areas that where we hedged, and it actually helped the portfolio significantly again on the downside. Now, maybe you are working with us or you've seen some of your portfolios and you say, Mike, I don't have any hedges on right now. What's going on? Well, in October of this year, the S&P 500 dropped 10% in about 30 days, and the NASDAQ dropped 15% in about that same time frame. So if you didn't have hedges on then, you didn't really want to put them on because they were very expensive, and two, a lot of the damage was done in the market. So these pullbacks happen pretty much every year. The market pulls back at least 14%, about 14.3% per year. So a 14% pullback has happened. So if you've already participated in a big pullback, sometimes you go, well, now I've already suffered all of the pain here. I'm not going to put hedges on. So sometimes we kind of wait for the rebound to happen, and we get the market to kind of stable off, and hedges get a little bit cheaper, and then we put the hedges on. So that's, again, just a little bit about timing and when exactly to hedge portfolios. All righty. So Mark, anything on that before I jump over to look at some of the Defiance?
No, I just think a lot of the things you're going to learn in this course, you may not necessarily be used today, but if you don't know they exist, you won't know how to do it. And I think one conversation before was with Mike was that we were talking about coronavirus, and during coronavirus, we started this course, the market crashed.
Sure.
I bought up, we started, me and Stella and Danilo, we started buying up leveraged ETFs, 3 times the market, starting by top stock options on Tesla. We had 1,000% rate of return in 3 weeks. So the point is that the rich people understand, they just have a higher financial IQ. They can see opportunities, right? And they're definitely hedging, you know what I mean? So, and people would go, well, can you invest with no risk? Okay, it's pretty easy, right? And somebody could put their money in bonds and then just take the dividends from the bonds and buy stock options every now and then. But why wouldn't you just wait for the market to crash? It does it every single year. Just wait for the market crash. You could have your bond portfolio, take some money, buy some options. You'd have a risk-free portfolio. So people say you can't invest without risk. I'm like, it's so easy to do. You just have to understand options a little bit and raise your financial IQ. And again, that's the purpose of this, and that's the purpose of this course, and that's the purpose of today, right? So cool. But that's cool. I bet you probably wanted to invest a lot more money after COVID, right? If you go back in time, right, Mike?
Yeah. Everybody I talk to says, hey, I wish we had that opportunity again, right? If we only knew what was going to happen, and we all, even though some of us did make money and made good opportunities there, if you just knew, if you had that opportunity again, how much more could you make, right?
Yeah.
I think it was a huge opportunity, and I'm drawing this red line here because this was really where COVID kind of hit, and then this was a major market downturn right here, right? And then that's what you can see. What happened though when you have these hedges on before these major moves like this is you have what's called avoided losses, right? So you're avoiding the downside move in the market, and that's exactly what happened here. And so, and that's what I mean by saying, if somebody loses 30% and you only lose 10, well, when you only have to make 11 to get back to even, that person that lost 30 has got to make 43%. So you're back up to even really quick. And then that person still got 30-35% to go until they get back to even. So again, by avoiding losses, that helps you build your portfolio over time. So again, COVID is a great example. That is a true black swan event. And all that means is that the market just dropped very significantly over a very short period of time. It was something the market did not see coming.
Yep. So I had a triple short on the market when it was going down, SPXS. It hit the bottom.
That's a great one to own, right? If the market's going down.
And then it hit the bottom, and then it turned it around. And it's like called Danilo and everybody else like, dude, let's start investing. So it kind of had some good timing. So
right, absolutely. And it was a great time to invest. So so let's just talk briefly about Yieldmax and Defiance. And actually we have some new positions coming too. So if you you may have heard of this website, but Yieldmax ETFs is our website, and is a website that our firm actually is part owners of. And so we've launched a number of different ETFs, and our trading team is very much involved in this. I'm on the financial advising team. It's a little bit different, but our trading team does the back office and trading work for Yieldmax as well as Zega. And just to show you guys a little bit of detail on this, and I'll just click a couple or one of these so we can look at some dates and things like that. But TSLY is a big one, and it has it's really grown dramatically, but it has a very high distribution yield. You can see that right there of 61%. These numbers are updated every month. And so what this is this is being long Tesla and then selling covered calls over the top of it. So inside of the ETF, we're doing that covered call strategy that I showed you. It's slightly different because we are what's called a synthetic covered call. Not much that you need to know there. It just means that we're trading the stock a little bit differently inside of the position, and you're still long. And if it goes up, you can make money, and if it goes down, you can still lose money. So it's just what's called the synthetic position with a covered call over the top, very similar to a covered call. But what we're doing is we're buying TSLY in this example, or Tesla in this example, and we're selling covered calls. Now, if I go back to the main page, you'll see a number of positions in here. We do this on ARK, which is ARKK, right? It's called OARK with us. We have an Apple position. We have an NVIDIA position, Amazon, Facebook, Google, Coinbase, Netflix. This is Disney. There's some more stable positions in here like Disney and Microsoft and ExxonMobil. So we've added quite a few positions in here. Our newest is the IWMY, which is an AI. This is the group that started ChatGPT, and we are selling covered calls over that position. There's a reason you don't see any information here. We look across the bottom, and that's because it's too new. We don't have the information on that yet. And we also actually did biotech position recently in Moderna. So we're creating really a diversified portfolio of individual positions here where we are, again, going long the stock and then selling a call inside of the ETF. And just to give you some reference on this is MSF, right? Microsoft. O means Microsoft with options. So that's what the O stands for when we put an O or we put a Y. It stands for yield. Again, because we've made these yielding positions. Remember, Tesla does not pay a dividend. So what we've done is we've turned Tesla into a dividend-paying stock, or the ETF around Tesla into a dividend-paying stock. The same thing with ARK. It might pay a small dividend, but we've really increased that. Apple's a great example, and just because we trade that quite frequently, and that's it's about 0.5% dividend on Apple, but look, we're able to do a 30% dividend or 27% currently. And again, these numbers will change based on what's happening in the market, based on what's happening with volatility, downside, all of those different things. But these are great positions that we have designed for you to access the options market. So you're thinking, hey, I really like options, but I don't have the time to learn them. Well, you can access it through these independent ETFs. And you can get options work done, just for buying an ETF. So I think these are a neat way to play, especially the tech companies in the market. And they're a very interesting way to generate income off of the volatility that happens in the tech market.
Yeah, and just to clarify this, I'd never heard of a synthetic covered call before these things were created. So they basically, correct me if I'm wrong, they take the money, they put it in U.S. government securities and cash, about 85% roughly. We'll give it at that. And then they basically buy a call option to bet up. So the call option gives it the upside. And then basically they can sell calls and puts shorter time periods to generate the income. Is that roughly how these things were built? Is that pretty accurate, Mike?
Yeah. So there's the interesting part is about treasuries, right? Everybody knows that interest rates have gone up. And so treasury bonds right now are paying about 4 or 5%. So what we can do, and thinking about a synthetic position is just like being long stock. We just replicate the long stock with options. That's all you really need to know if you're thinking about a synthetic. So, you know, if you buy 100 shares of Tesla, it's just like being synthetically long, one call option and synthetically short, one put option. So you're buying a call and selling a put, and it just gives you the same exact exposure. You feel like you own 100 shares of Tesla or one options contract. So they go up and down together, and it's just a different way to trade them. The neat thing about this is if we only have to use a certain amount of capital to invest in this position, well, what do we do with the other 85%? We have 85% of our portfolio in cash right now, right? So what we can do is we'll actually buy a treasury, which will generate us income. So it's just kind of a neat way to be long stock. We do this in large individual accounts, or we do this inside the individual options position. And by the way, if you saw that, Coinbase just popped up on the screen, and it had 113% distribution yield currently. So obviously, if you think about volatility, the more volatile the stocks you'll see on here, the more volatility created, the more income, right? If we go over to Disney's got a lot lower income. Look, you can see 24%, right? Well, think about volatility for a second. Coinbase is a very volatile stock. Tesla is also a very volatile stock. Netflix, I saw, just came up there, pretty volatile. Disney's not so much, right? And if we go over, let's go over to, there's a good one. Looking at ExxonMobil, 13%, a much lower dividend. And so again, that's example. ExxonMobil is a lot less volatile. JP Morgan's now just came across the screen, a lot less volatile. You're getting about 13, 14%. Now, if you said, well, Mike, why don't you just buy me all Tesla and why don't you all buy me all OR, right? We want to be diversified. We want to hedge our risks, right? We don't want to be too many eggs in one basket. So again, it's good to own a basket of these positions. And some of them will pay higher at sometimes, and others will pay higher at other times. So it's good to be diversified. I'll tell you this, OARC was a big dog for a little while, and everybody said, why do we own this one? And then all of a sudden it had a huge month last month, and everybody said, oh man, I wish we would have bought more OARC. So again, it's good to be more diversified. We certainly believe in it. You can see all the individual positions here. Again, I'll click over to this screen, and you can just see, well, that was actually not going to show positions. Hang on a second. I want to just pop back over to that. Here, if I click on this full list, right, you can see we have a number of different positions. So it's good to be diversified across the board. One other thing I'll talk about before we get into Defiance is dates. And I've had a lot of conversation with people around dates and when do we, what date means what. And I'll tell you this, we do this every day and it's confusing to us. And we talk about it every day, and sometimes we even get it mixed up because we just have so much going on and everybody talks about the dates and when to own and when not to own. So the declaration date's the day that the dividend is announced, right? And you can see this is, what are we on? We're on Tesla here. Okay, perfect. So we announced the 60% dividend on Tesla for the month. And so the declaration date is the announcement date. The date after is the ex-dividend date. So the stock's going to go down on the ex-dividend date. So immediately, if today's the declaration date, we're going to announce the dividend. Let's say it's a 1% dividend for the month. When we log into our computers tomorrow, we should see our position down about 1%. And that's because we're getting a 1% dividend, which is going to be paid out on the payable date. And what the record date means is, as long as you own the stock on the declaration date, that means that you will own it. It will settle, it just means that you officially own the stock on the record date, which is it's always 2 days after. Again, if you think about trading stocks, and anyone who's traded before, you might think about settlement dates, right? If you buy a stock today, it doesn't settle immediately. It takes a few days to settle. And that's why you have a declaration date, and then the ex-dividend date, and then the record date. So even if you sell on the ex-dividend date, you still owned it on the declaration date. Stay with me here because this one gets complicated. but the record date will stay, you still owned it. So again, you own it on the direct declaration date. That means it will be recorded 2 days later. So even if you sell it the next day, you're still recording it, owning it on the declaration date, so you will get the dividend. So that's what's important is if you want the dividends on these positions, you want to own it on the declaration date, and all the recording date means it just recorded that you own the stock on the declaration date. That's it.
Yeah.
So
if you guys go out and buy this thing
complicated
tomorrow, you're not getting a dividend, guys. If you buy it tonight, tomorrow, you're not getting a dividend. Just to clarify that. So cool.
Correct.
Okay.
So
That's
what
correct.
about like next month? So if I buy it on December 6th, come January 6th, because I was thinking about buying some, but I wasn't sure. I didn't want to buy it a day late and then miss out on the dividend in January. So if I want to get the dividend in January, what date do I need to buy it?
So for the Yieldmax positions, it's usually about the 5th, 6th, or 7th of the month. That's what you can see, right? You see kind of a pattern, right? Here's 12-6, here's 11-7, 10-5, 9-7. This was the 3rd, so a little earlier. So you really want to get in, I'd say the 1st or 2nd of the month. And that way you're owning it, because this was the early one, right? As we look at what's that, October? Right. So this one are not October, July. We just no, it is October. Sorry, it's kind of small on my screen too. But yes, you want to get in before this date, or at least on this date. It looks like, as again, all of these positions, it was the 3rd through the 7th, and that makes sense. These positions declaration date is usually around the 5th of the month. It all depends if there's a weekend, right? Also, right? So we can't announce on a Saturday or Sunday.
So this declaration date, I need to buy before that date to get the dividend the following month.
On or before. Yeah,
Clear.
on or before.
Thank you.
Now, what's important too is that there's the stocks drop by the dividends that come out. That's what happens on the X date. But there's something that's really neat that happens with the Yieldmax positions, and I'll get into that in a second. But let's say you have a $100 stock and you own it on the declaration date, and it's going to pay a $1 dividend. Well, your stock should be worth $99 the next day. That's just how the math works. You're going to get a $1 dividend, and it's going to come out of the position. Now, the idea is over the next month that position will appreciate again in value. Why? Because stock markets go up over time. So that's what you want to do. You want to collect your dividend and stay in the position and ride the position higher. But the neat thing with TSLY and IWMY and some of these other positions is that these stocks are so volatile that the underlying price can actually move up. So you might come in on the X date and go, well, I got my 1% dividend, but instead of $99, it's actually trading at 101. Well, that's because there may have been great news overnight with the Apple or Tesla or one of these other positions, and we had a big significant increase the previous night. So again, these are a little bit different than your typical dividend stock or a low volatility stock. You want to get that dividend, right? Because you want the income. But again, you might not lose everything, just again, monetarily, at least on paper, because you have stock movement as well inside of the ETF. Again, if we have a great night or a great day the next day in Apple, you can make the whole dividend back and more just in one day. And we've seen that happen multiple times. So it's just something to be aware of. If you want the dividends, you definitely want to own on the declaration date. If you want to buy it at a little bit of a discount, but you're just thinking, I want the dividend next month and I want some appreciation, you could always buy on the X date or a later date. We're big believers of owning the dividends, right? That's gonna give you income. That's gonna build your portfolio. Is the injections of cash that's going to come from these positions. The other thing that's a little unique about this is our dividends are not a dividend from a company, right? We are not a company that earns money and pays a dividend. Think about AT&T for a second. AT&T has lots of customers that all pay their bills, and what they do is every quarter they give some of that money back to people who own their stock. Right? That's a company or corporate dividend. The dividend that we pay out is actually from the premium of the options that are sold. right? So go back to the options works. Let me say that one more time because it's a bit technical. The dividend that comes out of these ETFs, there could be a little bit like Apple and Microsoft and a couple of the other ones, but the majority of the income that's given on a monthly basis is made up of the premium of the covered call that is sold. Let me just pop back to this other page because I think it just adds so much value here. Let's see. This is perfect, right? Let's go back to our covered call for a second, right? This premium that we are generating right here, right? This is what our dividend is. We're generating premium by selling that call, and then we're giving out that premium versus just a regular dividend. Now, some of our stocks do get dividends, but we're giving back the premium. That's why we don't have so much NAV depreciation in some certain scenarios, because we're not a dividend company like AT&T. We're generating income from selling the calls, plus we might get a little bit of dividend as well. And then between the two of those, we're giving some back. Now, again, you'll get a little bit of NAV depreciation right away, but the idea is markets go up over time, so your portfolio should increase in value over time. I hope that makes sense. Let me stop there on Yieldmax. Mark, any questions?
No, it sounds good. Like I said, if you have to understand what's going on in that thing, they're basically money's in the U.S. government securities or cash. They're buying that call option to bet up, right? Now, I don't know. That could be 3 months out, 2 months out. That's where their discretion. That's where you get guys who are experts on this. And then they're selling those options. Remember, every time they sell it, you're collecting the revenue, right? So they can't give you the revenue and then the dividend comes in, they give you it again. That's why it drops, right? So because they're selling that premium, you're collecting the premium all month long. So would that be right? Good description there.
That would be correct, right? Yeah. So and a lot of times on these Yieldmax positions, we are actually selling. We're actually selling weekly call options on the position, so it's very frequently traded. Yeah. This is an example of quarterly calls because we do this strategy as well. But yeah, the Yieldmax, we usually do weekly positions there. So again, it's a little bit different and a little bit more frequent. But the nice thing is it's inside of an ETF. So you don't have to do it. You don't have to worry about it. We just are going to distribute the yield every month. And sometimes you're going to have better months than others, right? If we go back to our dividend max page here, and I go back up to the ticker that goes through, is you'll see that, oh, actually we can even look through here, right? Tesla's got a nice 61% yield. Well, the OARC one this month has a 21% yield, right? Apple's 27, Nvidia's 28, 26 on Amazon. Those are all pretty good. But let's see, if I come down to JP Morgan, like I mentioned before, that's a 12% dividend, right? Less volatility, less premium generated. We give out a little bit smaller dividends. And then you got some really busy ones right now, like Squarespace, that's given 103%. And I think I saw, Coinbase is 113. Again, those are newer companies, lots of volatility, lots of premium. If you're thinking, hey, I like this option, that stuff, I want to do it on my own, you probably better start with a less volatile stock to just kind of, as you learn and get used to it, to understand that before you jump into a Coinbase or a Squarespace, or even a Tesla, right? Tesla has gone up 100% and down 100%, or about 90% over the past 12 months, about 14 months, 15 months. But again, a lot more volatility in those stocks, so they can be a little harder to trade than maybe something like a JP Morgan or a ExxonMobil. All right. So that is Dividend Max. If you'd like to learn more about that, obviously, reach out to Mark. He will connect you with us. We can talk about some of the strategies that we run on Dividend Max. All right. I got one more thing to discuss tonight, which is Defiance. And this is something that we're really excited about. And we have partnered with them on this as the traders as well, right? Again, so our trading team at Zega Financial does the back office work and does the trading for some of these individual ETFs. Really, the top three are the one that we target. Some of these are just kind of, we have nothing to do with these five down here. But what these are is, here's a basket. And I love the way that we've named these things, right? Because you kind of, what they are here, right? If you look at the top one here, it's JEPI. It's the S&P 500 Enhanced Options Income ETF, right? you're gonna own the S&P 500. That's what this is. You look at the QQQY, right? This is the NASDAQ enhanced option strategy. You're going to own the Qs, right? You're going to own the tech market. And then IWMY, this is going to be the Russell 2000. So again, those are the smaller cap companies that are out there. This is a little bit newer of a strategy. All right. So if I just look at the JEPY position, currently has a 42% yield, pretty good. And what this does is this utilizes 0 DTE options. And all that means is we sell options every single day in here, and they don't settle for stock. They settle for cash. And what that means is if I buy an Apple option and I want to exercise it, well, I can get the Apple shares when I exercise it. A 0 DTE option, there are no shares. Everything settles at the end of the day to cash. You don't have the right to buy the S&P 500 or the Qs or even the small cap market. It settles cash every single day. You can't get any stock. You can only get cash or lose cash. So that's what that 0 DTE means, is that they're cash settled. So, and this is, sorry, you going to say something, Mark?
Yeah, for sure. And just to let you guys know, there's like, this stuff never existed in the form of an exchange traded fund. Like you couldn't do this. So basically, again, they take the money, they put it in US government securities or cash, right? And then they sell a one-day put. It's a one-day contract, right?
Correct.
On the NASDAQ or the S&P 500. They sell it, they collect the premium, and then it expires at the end of the day. So you keep the premium every single day. They're, as Sylvia said, taking a bite of that apple, just a little bite every single day, and they're collecting that premium every single day. Never been done before in exchange traded fund. And again, like I said, it's got to be innovative, disruptive. This is definitely both of those things. And that's why, it's kind of cool that we actually are even connected to, the guys who are doing all the innovation and disruptive. So anyways, I'm a fan.
Yeah, you're absolutely right here. And so one thing I wanted to point out, because I get a lot of questions about declaration, ex-dividend, record dates, things like that. Again, the declaration dates here are actually a little bit different. They're usually the end of the month. So just keep that in mind if you're interested in these positions, right? You can see this is for the JEPY position, right? You can see and we've actually already declared the declaration date here. So as long as you own it on 12/27, you're going to get that dividend, which will be, it's going to be payable out next year, which is great, which we don't actually, so we don't know how much it will be yet, but we know what day it will be, versus Yieldmax. You can get a little bit of variance in there, just with the different dates. So kind of neat that we get to pick you get a little knowledge early with this one.
Right.
Mark had mentioned treasuries a couple times as well. So this is really neat. If you look at holdings in the portfolio, here's the treasuries we actually own inside the portfolio. There's one that expires on, well, this is 11/15. So we probably have to update this monthly. That's why you'll see some information might be a little dated, but right. And here's another one that expires on 12/31, right? And that's paying us 0.75%. That's about a 1 month. That's probably about a 2 month treasury bill that we purchased when we looked at this position. So again, we're buying treasuries with the extra cash in there.
Mike, can you hear me?
Yeah,
I have a question, and hopefully it doesn't go too much out of subject. Just out of curiosity, if you're trading the index, right, itself, and it settles as cash, I think they call it European style. I don't know if I'm correct on saying that. Does that benefit from some of the tax benefits of trading the index itself? That I think it's a 1246 contract or something like that when you trade indexes, at cash settlements.
Yes. So okay, good question. So there's actually, what Danelle was talking about is actually a rule that helps with tax efficiency inside of a lot of these ETFs, and you trade them. These specific ETFs do not benefit from that tax rule currently. We are looking at some ideas on trying to benefit from that. And it actually, a quick history on that is that has to do with farmers. That was actually put in place to farmers so they could hedge their crops and their cattle, and they didn't have to pay all short-term capital gains on any profits that they had. So it's actually, they split that rule to it's a 60% long-term and 40% short-term to benefit farmers. So quick fun fact for you, on why those were created. It was to benefit farmers because they were mad about all the taxes they had to pay. So no, we have some new positions coming out that does take advantage of this. Mark, we've been talking about theta recently.
Nice.
That's a new one that maybe we'll save for next month's call. But that one, it does take advantage of the 1046 contracts and gets a little bit of a tax advantage. So really good question, and it's a very interesting rule that farmers were put in place around 100 years
well, thank
ago.
you, man. I appreciate it, because that's actually a cool little piece of history and story.
Yeah.
So but I was just curious as soon as you said that. So thank you, man. I appreciate it.
It's a neat rule, and we take advantage of it when we can. So again, just more information if you guys want to look at this at defianceetfs.com. This is the JEPI position, the Qs again, and I think this is always interesting, but I talked about Yieldmax a little bit, right? But if you think about the S&P 500, give me just a second here as this updates. All right, perfect. There's Sylvia. If you think about the S&P 500 and versus the NASDAQ, right? Well, what's more volatile? Tesla, Apple, Google, Facebook, or the S&P, right? Which is AT&T, and it's got some Microsoft and Apple in there, but not nearly as much. Well, more volatility. So let's go over to QQQY and look, more volatility, more income. That's got a 60% dividend, right? So again, this is an index that's a lot more volatile than the S&P 500, so it should generate more income option-wise. Again, this is also zero DTE options where we sell puts. So people go, well, why don't we just own one or the other? Again, we are diversified. These are two very different strategies. The Defiance positions are selling zero DTE puts every day where we create just a little bit of money. The Yieldmax positions are synthetically going long Apple and Tesla and Amazon and Facebook. And so if the market goes up, we are participating in those stocks, right? And same thing here is if the Qs can go up, but we don't get a lot of the upside sometimes when QQQY goes up because we're selling puts, right? And so we might get some of the upside, but we're just looking to make a little bit of money, or like Sylvia and Mark said, is take a little bite of the apple every day, right? So some months QQQY will do better, JEPY will do better, and the small cap position. Other months, you'll see the Yieldmax positions do better. So again, it's why we have a diversified portfolio. It's highly focused on income, which I think fits in very well with buy, borrow, die. And for the most part, these positions have worked out very well and very nicely together. So with that being said, I think I've taken way more than 30 minutes, Mark, of your class tonight. So I'm sorry I talked so long, but we just got into so many details, and I hope you found it very helpful and useful. And if there's any questions, we can certainly open it up.
No, it's totally cool. I think we covered everything we wanted to do today. That was awesome. Again, we were sitting here like going, man, how do we we need somebody to work with, and then suddenly I was interviewing Jay, and it's cool. So we're very excited to work with you guys just because you're so in line with what we do and automate your income. We're all about income investors and stuff like that. And then of course, like I said before, we're going to go in the course later on. We're going to talk about how to use real estate to wipe out even all your dividend income, your W-2 income, and that sort of thing. So anyways, awesome. Thanks for being here, Mike. We appreciate you, man. And we'll let you I know it's pretty late there, so we'll let you go home to the dog, right? The new dog.
Yeah, absolutely. So we just got a new dog, everybody. That's why I haven't slept in a few days. So I will go take care of him. But listen, thanks for having me on again. I really appreciate it. We kind of went a little long tonight, but this stuff is very complicated, and we get it, right? Mark's absolutely right. Zero DTE options, daily puts, never been done before. All of a sudden, we're yielding 60%. Synthetic covered calls on high volatility stocks. Also, it's been done, but never in the format that we're doing. So there's a lot of intricate pieces to it. We're happy to talk to you guys offline or one-on-one about it. Just connect with Mark, and he'll make sure we set up a call. Yeah, and like I said, I guess I could show I don't know. Do you have a snapshot quickly of the portfolio that you guys currently hold for the dividend? Yeah, good question.
That'd be kind of cool just to show that, because it's super diversified. Because you're going to have times where like SQ is just surging, or AI, or the other ones are surging, and you may have one going down, And it's cool to see how you guys diversify that. And then of course you guys can even put the put option in there, which if you have a black swan event, like a coronavirus event, could be an opportunity to make more money. So I think that's the last thing I'd love to see, is just kind of see what you guys do as far as building a diversified portfolio of, Defiance and other positions, and then also the Yieldmax.
Yeah, so let me just pop that up. We just made some recent changes on Friday. And
every time I talk to you, it's a little bit different. So I'm like, yeah.
I know. We always tell you, oh, we're not making any changes, and then all of a sudden we make a bunch. So we just made some changes. Show you a quick screenshot of the portfolio. I'll try to highlight some things here. And this is, and we're okay showing this too, because it changes so frequently. But
yeah.
These are all of the positions in here, and I'm going to highlight in blue what we actually trade. Here are the Defiance positions, these three, and then here is the new Theta position here that actually we just that is actually brand new, and that's actually partnered with on SoFi. So we can talk about that another time. Well, let me back that up. So this just shares a quick screenshot with what's going on in the portfolio. Again, it is a very diversified portfolio. It owns a lot of different positions. That is on purpose. And we understand that one of these is going to, just shoot the lights out and do very, very well. But that's okay, right? We don't know which one of these is going to do that. That's why we own all of them. We have bigger sleeves, you can see here, percentage-wise, in QQQY, JEPY, and IWMY, right? You can see there's nice big chunks here, but we're diversified here as well. Anything you see that's not in blue is actually a covered call ETF that's traded by another company. That's not traded by us. So this is what's called true open architecture. And all that means is we are fully open to the market, seeing what the market does, what it likes out there. And if we find a position that we believe is traded better than ours, we'll buy that position and put it in the portfolio. And Bill is one of those positions. And PDBC is a great commodities position with a 13% yield. And then these are all fixed income positions that we've added to the portfolio also. So again, there's some people that are doing this as well. We think we do it the best with these specific positions. But again, we're looking for other ideas as well, and we're not afraid to use them.
Yeah, for sure. And again, you guys rebalance the portfolio at Zega, and then also you guys can put that put option there for downside protection, just in case that, we have another black swan event that hits the markets. That put would rise in value and essentially, could stop it from falling, but also you could even sell that thing and then even make more money. So again, those are conversations you guys can have with Mike if you if you wanted to, you wanted to have a conversation with him about, money management. So yeah, awesome, dude. Appreciate it. All right, man. Go home and
thanks so much, guys. Listen, have a great evening. If you have any questions, again, please connect with Mark or Danilo. They can set us up with a meeting. We love the opportunity to speak with you, kind of dive into this in more detail, even more detail than we went into tonight. So thanks so much.
Cool.
Thanks, man.
All right, guys. Bye-bye.